Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about China Literature Limited Annual Report. China Literature Limited offers a diverse range of businesses and services through its online literature platform. At the core of its operations are online text publishing, advertising, and game publishing under its QQ Reading, Kidian, New Classics Media, and Tencent Animation and Comics brands. The company also engages in various other activities such as producing, licensing, and distributing film, television, web, and animated series. Additionally, it provides copyright licensing services, sells adaptation rights and scripts, and distributes short-form dramas. Furthermore, China Literature Limited offers sales of physical books and intellectual property merchandise products, as well as online games operations. The company also operates through its in-house platforms to provide reading, copyright commercialization, writer cultivation, and brokerage services. It utilizes technology methods and digital media, including personal computers, internet, and mobile network, to operate textwork reading and related open platform. Moreover, China Literature Limited distributes online audiobooks and online comic content via Tencent and third-party platforms. Overall, the company's business scope is extensive, covering various aspects of literature, entertainment, and intellectual property management. China Literature Limited maintains a market capitalization of 30 billion, broadly in line with the industry peer group. China Literature Limited trades at a higher price-to-earnings ratio of 195 times and a higher price-to-book ratio of 1.53 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The balance sheet appears very conservative, with liabilities representing only 20% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The income statement shows that the company revenue have been declining annually even though operating income have been improving. Although the drop in revenue is concerning, we can tell that management have been able to reduce cost. Interest expenses are consuming a significant portion of operating income, indicating some financial strain. However, special charges appear non-recurring, suggesting that earnings pressure may be temporary rather than structural. The primary drivers of revenue growth or decline can be identified through a comprehensive analysis of the extracted summaries. On one hand, several factors have contributed to revenue growth. The success of animated dramas and IP merchandise business has been significant, with both exceeding RM$100 million in revenue and RM$0.1 billion in gross merchandise value, respectively. Additionally, the premium online reading content ecosystem has attracted a large number of new writers and generated numerous new novels. The company's premium content strategy, which involves frequent breakout hits and a diversified matrix of high-quality content, has also been instrumental in driving growth. Strategic investments in short drama segments and animated drama initiatives have further contributed to revenue expansion. Furthermore, the company's global expansion through AI translation has led to a 39% year-over-year increase in revenue. On the other hand, several factors have contributed to revenue decline. The decrease in advertising revenues on Tencent channels and scheduling delays, leading to fewer releases of drama series and film projects, have both had a negative impact on revenue. Additionally, the online business segment experienced a decline of -9.3%, with a significant portion of this decline attributed to a -21.1% drop in advertising revenue on Tencent products. In conclusion, while several factors have contributed to revenue growth, including the success of animated dramas and IP merchandise business, as well as strategic investments in short drama segments and global expansion through AI translation, other factors such as decreased advertising revenues and scheduling delays have led to revenue decline. The net income of the company experienced a significant decline, with a decrease of 13.4% and a reduction in net income by RMB 411,789. This downward trend continued in 2025, where the net income decreased by RMB 708,964,000 compared to 2024. The profit margins also underwent a substantial change. The gross margin declined from 48.3% to 46.1%, indicating a decrease in profitability. Within the intellectual property segment, the gross margin dropped by 0.3%. Additionally, the acquired TV and film business saw its gross margin decline from 45.3% to 40.6%. The operating margin also experienced a significant drop, decreasing from -4.1% to -10.9%. Furthermore, the net margin plummeted from -2.6% to -10.5%, indicating a substantial decrease in profitability. This downward trend is evident across various segments and periods, suggesting that the company's financial performance has deteriorated significantly. The company's debt level and interest expenses have undergone significant changes. On one hand, the total debt has decreased by a substantial 26.3% from RMB 2,308,000 to RMB 1,709,000. This reduction in debt is a positive development for the company. However, on the other hand, the interest expenses on borrowings have increased significantly, rising from 0 RMB in 2024 to 134,000 RMB in 2025. This increase in interest expenses may offset some of the benefits of reducing the total debt. Additionally, while the interest expenses on lease liabilities decreased from 8,611,000 RMB in 2024 to 7,034,000 RMB in 2025, this reduction is not as significant as the increase in interest expenses on borrowings. Overall, the changes in the company's debt level and interest expenses suggest a mixed picture. While the total debt has decreased, the increased interest expenses on borrowings may have a negative impact on the company's financial performance. The performance of various segments and regions within the company has been mixed. In terms of poor performance, the online operations saw a decline in revenue from RMB 4,090,485 in 2024 to RMB 3,319,134 in 2025, accompanied by a decrease in gross margin from 45.6% to 39.8%. On the other hand, the intellectual property segment performed well, with a slight increase in revenue and an improvement in gross margin. The business and others segment also experienced a decline in revenue, but its performance is somewhat unclear due to the lack of specific details. The PRC region, as well as the intellectual property operations and online business and others segments, do not provide clear information on their performance, making it difficult to assess their overall standing. Management is optimistic about the company's outlook, citing a strong leadership position in animation, with 9 out of 10 top titles adapted from their intellectual properties. This dominant market share positions them well for future growth. To further expand their reach, they are diversifying into new genres and building a diverse content matrix. In terms of strategy, management plans to fund capital expenditures and long-term investments using cash flow generated from operations. This approach will enable the company to continue investing in its core business, while also exploring opportunities for growth through strategic acquisitions or partnerships with complementary businesses. While acknowledging potential risks and uncertainties that may impact their forward-looking strategies, management remains committed to driving growth and expansion. By leveraging their existing strengths and diversifying their offerings, they aim to capitalize on emerging trends and stay ahead of the competition in a rapidly evolving industry. Concerns about inventory buildup and supply chain disruption are growing. The data suggests that companies are holding onto more stock than before, which can be costly. For instance, the cost of inventories rose by a significant 30.7% from 2024 to 2025. Furthermore, raw materials inventory increased by 35%, indicating that companies may not have been able to manage their supply chains effectively. The issue is compounded by supply chain disruptions, which can lead to stockpiling and inefficiencies. One notable trend is the increase in inventories held with distributors on consignment, rising by a substantial 55%. This suggests that companies are struggling to get products to market on time, leading to inventory buildup and potential losses. Overall, these trends indicate that companies need to reassess their supply chain strategies to avoid further disruptions and costs. That concludes the financial summary for China Literature Limited. Feel free to comment below, and I will be happy to answer them when possible.